Welcome to our Stearns Financial Group live Zoomcast. Today we're talking about inflation versus deflation, which over the past 25, 30 years has been a hot topic from time to time. Not so much lately since inflation's been pretty tame, but it is heating back up. And have with me today two of our investment committee members, Glenn Joyce, our co-chief investment officer, and John Thomas, JT, one of our senior advisors and partners. And then we also have with us Tara Maxwell, who is our financial planning manager and latest and greatest partner to be added to the Stearns Financial Group partner roles. So welcome all. Kicking this off, a story from many years ago. I was with my doctor for an annual checkup, and he said, "Dennis, do you know what the silent killer is?" And he looked at me with this grave look, and I'm thinking, okay, I think it's high blood pressure, and I think I've heard that once you find out about it, maybe it's done damage, and I'm thinking all these things about, tell me what's going on. And he said, it's inflation. And he took this opportunity, as he sometimes has done over the years in our annual checkup, to get some free financial advice from me. And he wanted to know if inflation was really going to be a problem. And so I've always remembered the silent killer metaphor. And as we had in our last written Poolside Chat, we showed in that chat that over the last 20 years, at an average inflation rate of only about 2% a year, which seems pretty tame, that the Department of Labor reported that over that 20-year period, the average cost of the stuff we buy had gone up 50%, actually a little more than 50% over that period of time. And that's at only a 2% inflation rate. So maybe the debate today about inflation, will it heat up? Maybe we just need to figure out how to make sure we have counterbalances, because even at low rates, it can be tough. So let's get into it. Next slide, please. So Glenn, kick us off with a rousing, in-depth discussion of John Maynard Keynes, the famous economist who studied inflation back some 90 years ago.
Yes, thanks, Dennis. Yeah, just kind of starting out with these first two slides, maybe a good overview on Keynes and his policies, Keynesian economics. And yeah, he did kind of develop these in the 1930s as a way to kind of help explain the Great Depression, or at least to better understand it. And I think it's, it's born out of, prior to that, there was this classical theory, which was more around the economy kind of self-regulates through these natural economic forces and incentives. And Keynesian, or Keynes took a more approach, we need to have more active involvement from the government, the monetary policy, the fiscal policy, as a way to kind of help prevent these economic slumps and have a more optimal economic output. So that was kind of the basis, more active policies, monetary and fiscal, to help kind of just keep eliminating or trying to reduce the impact of these downturns and make more for a high profile economy. So the classical definition is too much money chasing too few goods. And yeah, you think about that, and things get bid up by demand, kind of outstripping supply. So that's your classical definition. As we get further into this presentation, we'll talk about other considerations like currencies and how currencies can also impact inflation. But I think maybe we'll go on to the next slide and delve a little more into John Maynard Keynes. And this is talking a little bit more about this concept called demand pull inflation as part of the Keynesian philosophy. And one way to think about it is your demand is starting to, things are being driven more by demand outstripping supply, and thinking about, when that happens, you just naturally, right now I'm thinking about the US Open going on and there's nobody in the stands, but obviously if you had some high profile players playing right now and the ability to go there and not any health concerns, there'd be a lot of demand to see, some strong players, and that would obviously bid up prices like we've seen over time. And the first one, a growing economy, is when you think about something growing and you think about the confidence that may give folks, especially you see employment, and we saw today's job report looked pretty good. And so things are improving on the employment front, that naturally makes spending a little more attractive, and people are much more able to spend. That's been a big force, especially as we look forward and kind of think about where things will be headed near term. Now, one thing to consider is globalization has been a very big disinflationary force. And the things I hear we mentioned with Walmart and Amazon effects, those are things that while inflation generally does go with a stronger economy, there's been this massive opening up of the global landscape. And this Walmart and Amazon are poster childs for that, where we're able to kind of lock in on a variety of goods and services across the globe, and that's naturally had disinflationary forces. Now, as we think about asset inflation, we think there about what's going on with the monetary policy, fiscal policy, and how that can just cause prices to rise, especially for stocks and bonds. When you have low prices or low interest rates, that makes things more attractive, and that discounting rate makes their cash flows look much more attractive. And I think that's where you want to think about the currency implications. It's a little more challenging now. Everybody's trying to deflate their currencies or devalue them with interest rates being so low. And so you may remember the term, I think it was back in the 90s, the Big Mac index. It was a way to think about purchasing power parity and a way to look across the globe and think about these relative currency and exchange rates, and try to think about what's the true price when you try to take into account the different currency valuations. So I think it makes things much more complex today with that currency piece. And obviously if the dollar goes down, prices are going to be more expensive for us here in the United States, for example. So that's a form of inflation. Government spending definitely dovetails into Keynesian philosophy, that more active fiscal piece that we're seeing today and debating today in Congress about the next stimulus. And so, back in the 1930s, the New Deal, it was much more easy to me to focus on infrastructure. We were more on an island. But today, with the connectivity around the globe, it may be a little more challenging, once again, with everybody trying to do these same type policies. And then I think when you look forward, I think you would naturally think inflation would probably rise as the economy improves. And, that's something that companies try to do, is pass through the cost of inflation. If they're worried about their profit margins, they will then try to make sure that they are passed that along in the form of higher prices to the ultimate end user, the consumer. But now we have a little more leverage, since we can go across the globe and look at different competitors and try to figure out where's the best price in different regions. The consumer and business have a lot more power to negate some of that. And so companies are maybe struggling and not quite able to do that as much as in the past. And then, as we know, at the very bottom point, when you think about the money supply and you think about just how much it's grown, and you think about just what the government's doing with the printing presses to try to keep interest rates low and to kind of stimulate the economy, the key ultimately is going to be, and we'll see in a chart in a few minutes, it's going to get back to, is the money churning through the economy? Is it being spent, or is it staying on the bank's balance sheets? And we really want to start seeing it go through the economy and start to compound and really foster, more of hopefully a modest inflationary increase, and not too strong.
Yeah, and I think Glenn, that's kind of where we get the most questions from clients and occasionally physicians in checkups, is that the printing presses, that's the term that's used most frequently. When the printing presses get going, watch out. And yet, back coming out of 08, 09, printing presses were cranked up pretty well. No inflation ensued. So hit that when you're talking about the amount of money and velocity of money.
Yeah, I think this is really, that really dovetails well on this point. This is a key point here, is that we've seen this massive monetary stimulus and the money supply grow really this whole decade, going back to the great financial crisis. But as you mentioned, Dennis, we really haven't seen inflation really rise. And it's been at times it's fallen. And I think we're struggling to get to that 2% Fed target, where they think is just a good equilibrium rate for inflation right now. And we'll have a chart in a minute. We'll hit on that a little more from a longer term perspective. Right now, I think that the Fed would be happy to see that even breached, and see inflation go above 2%, as long as it doesn't go too high. We just want to see a healthy economy. And so while the money supply has definitely increased, M2 is a measure of the money supply. We're thinking about things like your checking account, things where you can have money readily accessible and very liquid. Now, there'll be, when you start talking about M2, you go a little bit beyond that. You go into things that may be like near-term cash that maybe can be accessed fairly quickly. It may not be in your checking account or savings account, perhaps. But the thing is, once again, we're not seeing that circulate, and that gets back to the demand side of the equation. The Keynesian focus is that people aren't either confident, either businesses or concerned about really opening up and doing capital expenditures, or consumers are worried about their jobs. And we haven't seen the spending like we like to really get that money circulating in the economy. And we think as we hopefully get more clarity on where we're headed with the economic recovery, we think that will improve. And obviously you saw the big slump there at the bottom chart where it really dropped down. And we think it's kind of lagging, and we'll see that turn as the economy starts recovering. But that's definitely a concern, and we need to see that for inflation to take hold, that velocity piece.
Yeah, and I think that's opening up a lot of perhaps future chats to discuss this velocity issue, because there's a lot of interesting papers. Some of them have been put out by the Federal Reserve. Some people have been doing some pretty deep analysis on banks keeping higher reserves after the Great Recession of 12 years ago, which is certainly true, and that may be part of it. There's a very entertaining video on Investopedia about velocity of money, about money changing hands between 3 different people. But what if the 3 different people aren't in your own village or in your own country even? What if some of them are outside the country? So again, pretty complex forces that are at play when it comes to that velocity piece. So let's go to the next chart.
Yeah, this gives you a good long-term profile going back through most of the 20th century, back to 1913. And you can see inflation was much more an issue the first half of last century. And some of that was we were tied more to standards like the gold standard and things where, the monetary expansion in terms of being very open and using the dollar as the official reserve currency wasn't really utilized back then. And of course, we had the Great Depression. You can see some areas of red where we definitely had deflation and things were not going well. And then beyond that, we saw inflation pick up materially. And of course, we had, like, talk about the New Deal in the 1930s and some of the infrastructure investment that went on at that time. But then as you fast forward more, 1971 was that key point where we went off the gold standard here in the United States, and then went more to the US being the dollar being the currency reserve for the globe. And really, the other key point, as we talked about quite a bit in the past, is when Paul Volcker came on as Fed chairman and really decided he was going to focus more. You think about the Fed, they had that mandate of price stability, but also, they want to make sure employment is full. And he decided to err on more the side of not worrying about employment as much and focusing on price stability, and really jacked up interest rates in the late 70s, early 80s. And that's where you see that peak in 1981 of interest rates and inflation. And then we had that great disinflationary force from the 80s through the 90s. It was such a bull and tailwind for the stock market and really its financial investments in general. And really, since then, inflation has become less and less. So we entered this century, especially like Dennis mentioned, this last decade, we have been struggling to get anywhere, above 2% on a sustainable basis. And I think lately we've been more in the 1.5% range. So there's definitely been some episodes where it's fluctuated, and I think we'll see more volatility, perhaps, given the volatility in the markets and the economy. But I think inflation is something right now that's definitely on the Fed's radar, as we've heard more in the last week or so, and I think they're definitely wanting to see more of it as we go forward.
Okay, very good. And since I've always been sort of bugged when people are painted as complete villains or complete heroes in history when they are much more nuanced characters, I will mention that Paul Volcker, who broke the back of inflation when it was really out of control, was appointed by Jimmy Carter, who most people consider to be the villain. And I think there were other forces in play, but the villain of hyperinflation in the 1970s. So appointing Paul Volcker was a brilliant move for that, just for the historical record. Okay, so now we're going to get more into the weeds here, inflation by spending category. And Tara, do you want to dig into some of this?
Yes, so thank you, Dennis. I'm going to get a little more in the weeds So what this chart right here is looking at is it's over the last 20 years when average inflation was just over 2%. It was 2.06%, as Dennis noted in his introduction. When we look at by category where inflation was, it's very different. And so if we take the two outliers, we can see medical expenses increased by almost 3.5% during that same time period. And apparel actually decreased just a little bit. And so what this helps us see is that what is reported as average inflation could be a little bit different than what you experience as inflation, depending on where your personal spending is compared to the average consumer, which is what determines the average amount, because the inflation number that's reported is the weighted average of how we spend in these various categories. So on the next slide, what we're going to see, which is a common question that we get when we're going through roadmaps, is how does my spending compare to others? And so this actually looks at higher income households and decides how much they spend in each of the categories. And so if we took the weighted average of this, it would be really close to average inflation. But what we're going to notice on the next slide is that while average households spend just under 7% on recreation, when we look at our clients, we found that our clients are spending almost 25% on recreation. And so when we compare where our clients are spending money versus where the average consumer is, if we do that same weighted average calculation, what we determine is our clients may actually be experiencing inflation just under 2%. But this just looks at one day, and it doesn't look at what happens over time. So on our next slide, what we're going to look at is that over time, spending changes. And so what the purple in the top graph represents is how does your spending change once you're over the age of 75? And here I just want to highlight that healthcare, you spend about 5% more once you're over 75. You spend a little bit more, about 8% more in housing. And if we remember from that first slide that I was talking about, we saw that healthcare actually has the highest inflation over the last 20 years and maybe even going forward. So what we do in our plans at Stearns Financial Group is we really want to take all of this into account. And so on the next slide, what you'll see is we start with kind of a baseline. So for general spending for our clients, we've been expecting 3% inflation. Whereas if we look at the historical, it's been closer to 2. So that gives a little bit of margin of safety there. The other thing we do is we notice a lot of our clients spend on recreation, and that changes over time. And so we don't include it throughout their plan, but we include it when they expect to have those expenses. The other thing.
Oh, sorry. I was sorry to cut you off there, Tara. I was going to say we have a question from the audience. And maybe we should go back a slide for this question related to housing. And so the housing down below, average inflation by spending category, I believe is just rents, right? For housing, but yeah, okay. And it's interesting that up above it says housing dash mortgage. So maybe there's been a little different something added in by the analysis there.
I think, Dennis, the top one is just looking at where you spend money, and that includes your mortgage, where when they're measuring inflation, they're using rent as the component of that, because consumption inflation measures are based on consumption. Obviously, rent is housing consumed at a point in time, whereas mortgages are an asset growing in value, and so it spreads that consumption over a long period of time. So that's why they only use rents in the measure of inflation.
Yeah, and I think it's interesting. Of course, in the old days, very few 75-year-olds had mortgages. Today, it's still disproportionately low that they have a mortgage, but there's still some housing costs, and certainly repairs, upgrades to older homes. A number of years ago, we ran some studies on this. In fact, one of our studies was published in the New York Times about how older homes cost more than homes that are newer, which shouldn't have been a surprise to anybody. But it was double or triple the amount of ongoing maintenance. So the other piece that I think is kind of interesting here from what you were talking about, Tara, where people spend money. And so in the previous slides, we were looking at recreation, which is a combination on here of travel and entertainment, right?
That is correct.
Yeah. So again, I think it's interesting that over time, our clients have had a lot of nuances of how much travel. They might not do as much travel, but they might eat out all the time and hate to cook at home. And some of that, of course, appears to be changing in the pandemic environment. So again, I think all of this is interesting, but the real takeaway here is that it's how you spend money that may impact your inflation rate. And if you're going back to Glenn's analogy, when the US Open in tennis is back operational, let's hope a year from now, the tickets are probably going to go for some kind of huge premium, just based on the fact that you couldn't be there this year. But if you're sitting at home watching on TV, the cost is pretty much the same to you. So and how you travel it makes a difference. And we have clients who are consummate shoppers when it comes to traveling, and so there's all kinds of ways to affect the inflation rate within a particular spending category. Okay, yep. JT?
Yeah, so flipping to future slides, before we go there, the next few slides, Dennis and I are going to kind of run through a number of different asset classes and how they might be able to help hedge inflationary risks. Before we go into that, I just wanted to particularly commend Tara on some of the work she did to create this research among our client databases. And it is interesting to look at some of the contrast between the typical high income consumer and what we see among our clients. Our clients tend to consume a little bit less in food, beverage, housing, and certainly transportation, but a good bit more in the recreation areas and a little bit in medical care. It's also interesting to link this back to some of Glenn's slide and that question about monetary forces, monetary policy being a potential cause of inflation, and the fact that we have such low circulation of money. Obviously, right now, it's much more difficult to consume food and beverage in the same way, much more difficult to consume travel and recreation, even transportation in the same way. Arguably, as we'll talk about in a minute, it may be easier to consume in apparel, maybe easier to consume in some of the online shopping categories, but that has an impact on that velocity of money question as well, just that it's harder for folks to spend at the same level by the shutdown in activity that we're experiencing. So that counteracts that sort of monetary-based stimulus. All right, thank you, Bill. Why don't we jump ahead to, yes, inflation hedging investments. And we lead with stocks. Traditionally, stocks have been one of the best inflation hedges because companies have historically been able to, with only a mild delay or mild lag, they've been able to pass through a lot of their increased costs. Again, historically, a lot of the drivers of inflation were increases in wages and increases in raw material costs. Today, it's hard to see some of that. And as Glenn referenced, the Federal Reserve is being very direct about their intent to help inflation move higher in an environment where we have a lot of unemployment, where we have raw material commodity prices going lower in the areas of places like energy in particular. We don't have a lot of those typical causes of price inflation, goods inflation. So I think a valid question is, again, stocks have done a great job historically because they're able to pass those through and drive up their profits. We've experienced over the last 10 to 15 years the so-called Walmart or Amazon effects, which drive down the price to consumers because those sort of arbiters of price are squeezing profit, but they're also passing that through. So they're making it harder for those higher up in their supply chain further back in their supply chain to actually pass through those profits. Another big factor on this is going to be the effects of deglobalization. One significant factor over the last couple of decades that drove down inflation was globalization, bringing more supply into the global marketplace. With some of the tariff and trade disputes and a reversion to more localized supply chains, those are also inherently inflationary forces. The question will be how far that goes. And finally, the continued automation, is that going to be a means by which companies are able to sustain their profits, perhaps at the expense of labor participation? So, for instance, how do you measure inflation where you're comparing a phone in your pocket that has more computing power than a very expensive computer of 10, 15, 20 years ago? It's very difficult to measure what's the real inflation when you're seeing deflation through technology and automation. So big brush, we would still bet pretty heavily that stocks have a good opportunity to be an inflation hedge, that the ability to pass those through, but maybe more importantly, the collective creativity to find the balance point in supply chains, technology, et cetera, to maintain their profits. And obviously it's profits that ultimately drive stock prices higher. So still think stocks have the opportunity to be a good inflation hedge. Next category, you want to talk about real estate for us, Dennis?
Sure. And so real estate has been the other area that has traditionally been a pretty good inflation hedge. But when you talk about real estate, people immediately think about all kinds of different things. They may think about their own home and whether it's gone up or down. Well, for our clients who are watching this who are in the San Francisco Bay Area, over time, that has been wonderful. For our clients who are watching in the Midwest, maybe not so wonderful, although right now things in St. Louis are hotter than a firecracker in terms of their housing market. Apartments, when we think of investments, we're thinking more of investments in real estate that are collecting rents. Now that could include individual rental homes, although our clients have had mixed results and mixed benefit over time with individual rental homes. But apartments, those are things that can pass through the cost quickly because they have significant turnover of their tenant base. And so if you raise the rent 10 or 15 bucks a month, or as we've had some significant value created in our apartment complexes we've owned the last 20 years, if you've upgraded the closets and the master bedroom, bathroom, and the kitchen with extra granite and all the other nice goodies and charge $10 or $15 extra a month, well, you can pass that through fairly quickly to your tenants, and the new people who are coming into the apartment complex immediately get that pass through. Now, in the pre-COVID world, overbuilding was certainly a threat to an apartment complex ability to charge higher numbers. In fact, when you had overbuilding, a lot of times there would be rent wars right away, and there wouldn't be those cost pass-throughs. And that same thing is true in office space, same thing is true in public storage or other kinds of real estate. And we invest in about 12 different kinds of real estate, and again, it's different for each one. Offices tend to have longer term leases. And so as long as the office buildings have great amenities, you tend to have a little bit of less of those fluctuations. So again, all of this gets back to, if you're in real estate, diversification is a good thing. We've seen clients in the past who got a little too infatuated with perhaps one kind of real estate or one geographic location, and sometimes that doesn't work out as well. And then the one of the big questions that we hear all the time from the folks that manage real estate on our behalf is consumer demand changing in the future, and there is tremendous millennial demand. And while it is true that a number of millennials are buying homes, particularly with the low mortgage rates, the fact is that the last stats we saw were that 42% of millennials didn't want to buy a home. And it's worth mentioning that the millennial group in this country is bigger by a fairly wide margin than the baby boomers. So we're talking 42% of a larger number who are moving into their years of looking at apartments. And so again, there's future supply-demand trends that may make the past somewhat different than the future, but we would still say that real estate in general is a pretty good inflation hedge. So let's go to the next page. Oh.
Thanks, Dennis. So this is a really interesting portrayal of how different types of sort of real return assets, both real estate and a few other categories, have held up in different inflationary regimes. Now, the data is long-term in nature, but it also only covers since 1993. So looking on the left, during that period, you can see that average inflation has been really quite low overall, so well below 3%. And they've broken this into two different regime types, where below median inflationary periods and above median inflationary periods. Now, you can see immediate evidence that these categories have had very strong overall returns, no matter which type of inflationary period you're in, where their average returns over that 27-year horizon have been well in the upper single digits sort of territory. But interestingly, in each one of these areas, be it private real estate, infrastructure, farmland, or timberland, they 3 out of the 4 did better when inflation was higher or rising. So this, again, evidences that they tend to be a better inflation hedge. Again, that real estate component having one of the bigger differentials, as well as timberland. I think this data comes from one of our providers, Versus Capital, that is managing a good bit of capital for our clients in these various themes. I think a natural question that goes back to inflation right now, and Dennis alluded to it, is with the change in behavior, particularly around office and retail, how deflationary, how much could that negatively impact occupancy and rent collection or rent rates in private real estate? I'd first note that in the funds we're using, those components are a fairly small share of the overall private real estate, less than 40%. And so far, we've had some very good collections. So the Versus folks shared some of the information about their collections across the various components that Dennis alluded to, across about 12 different segments of real estate. And in the period from April to August, over 85% had a better than 90 to 95% continued collection rate. So very much on par with their historical collections, or even a little bit better. So at least so far, we haven't really seen the push through of lower demand impacting the ability to collect your rent from your real estate. So that's encouraging. I think, again, open question how much you may see some bifurcation based on that change of behavior going forward. But we're encouraged by the trends so far. So again, real assets have tended to be a better hedge against inflation. Go ahead, Dennis.
Yeah, thanks, JT. And I think one of the big bifurcations, one of the big points of branching of the road here could very well be that most of what we have invested in are A grade, some of the higher quality grade properties. And so the B grade or the C grade, which have less rent for tenants, whether it's multifamily or office or whatever, those have actually held up reasonably well. But a common sense question would be, how much is that because of the extra $600 a week from the federal government in unemployment insurance? And as that has been changing, will that be changing in the B and C space? I think it would take a lot, given the current environment. We would have to get things well on sale to even have us venture down into the C space. And I think even then, maybe only for our aggressive growth clients, just simply because of concerns we have about other things going on in the middle game and end game of COVID. But so again, I think quality matters, and that's kind of one of our big themes right now. Let's go to the next slide. Okay, gold. And Glenn, this is one that I know you have studied along with PJ and some others in our firm pretty extensively. So let me just ask you the really simple question. Is gold really a great inflation hedge?
You know, gold, I think, Dennis, it serves a variety of roles, but I think in terms of where we like to use it at SFG, I think primarily it's a safe haven investment because it does seem to diversify normally. Now, at times it's moved with traditional assets like stocks, and it's done very well this year. But traditionally, I think we look at it more as a diversifier, and definitely we see it in most scenarios as being a good place to be if you're worried about the economy going off the rails or the stock market falling. But as it pertains to inflation, I think where gold does not perform well, I'll say this first, is when things are going well, generally speaking, and that means that interest rates are rising more than inflation. You have a real return element that's expanding. But when you see inflation start to become more of a problem, like in the 70s, for example, when growth was not good, and we had a term called hyperinflation, where the inflation rate was higher, much higher than the growth rate of the economy, that's where gold can still do well, is when it becomes a concern where inflation is getting a little bit too robust and the economy's not going well. So I think generally speaking, there's a sweet spot where the economy's going very Goldilocks, I mean, a good way to say it, where things are going well and gold probably isn't doing that well, but it can do well in those really bad times. And when inflation really does start to spike, I think are areas where we typically see gold to be in a good place to be.
Yeah, and it's worth mentioning that in our history, there's really only been 3 times we have held gold as a direct investment in portfolios, but we've held it for some clients much more frequently as an insurance policy. And that is a very important distinction because, you know, if you have an insurance policy on your home, you really don't want your home to burn down to collect it. And you really don't care about the rate of return on that home insurance policy. You say, oh, darn, my home didn't burn down. I didn't get to collect on that. You really don't care. And so it is perfectly fine in our view, as long as you don't maybe get too carried away with it, because gold isn't producing any income. It's perfectly fine to also own some gold as an insurance hedge, even if it may be during a period of time where it's not really a great investment. Okay, let's go to the next slide.
Yeah, so thinking about inflation protected bonds, these are so-called, in our case in the US, TIPS, Treasury Inflation Protected Securities. So these are bonds that pay a nominal rate, but that they have an additional rate that depends on the inflation factors. So if you expect inflation to rise, you could expect higher income to come off of bonds like this. They're exactly designed to be an inflation hedge. We think they continue to do that fairly well. There's some questions about, because they're tied to consumer price index, if consumer price index is somewhat suppressed by the basket or the way it's measured, maybe you're not getting a full reflection of the actual inflation going on. But I think this is an example where, though there are questions, obviously, if the Federal Reserve is not able to accomplish its goal, is not able to stimulate enough growth in the economy to create some increase in inflation back to their targets, then if deflation continues to be a persistent issue, these type of bonds wouldn't really give you that additional real return or ability to stay a little bit ahead of inflation. I think our consensus would be that we're still willing to bet on the Federal Reserve long-term being able to accomplish their goals. Again, they've been rather explicit that after a period like we've been in, where the rate of inflation has undershot their target of 2%, they're even more willing to allow it to have a period of time where it runs a little bit hot or overshoots. So we still think inflation protected bonds can be a reasonable hedge against inflation, and probably are pretty inexpensive if we think that not near term, but over, say, a 3 to 5 year horizon, inflation does begin to rear back up. So we're expecting that we may be tiptoeing back in, wading back in to add some inflation protected bonds into portfolios over perhaps the next year or two.
Yeah, and just a reminder that the Federal Reserve allowing inflation to go hot is not inflation going to 4 or 5%. It would be more like 2.5%.
Yes.
They would be starting to do some significant intervention. So
Yeah, and I think, again, maybe this was better in the wrap up, but I think that's really the key point here is when we're talking about inflation, the Federal Reserve, the dot plot, the forecast of the expected nominal rate that they're going to be setting for the Federal Reserve Fed funds rate for the next couple of years, it's still expected to be at zero by essentially all of the Fed governors right through 2022. So they are hoping to create some inflation by keeping rates that low, but we're talking about inflation creeping up from 1.5%, 1.75% to maybe 2.25%, 2.5% over that time frame. So I think the wide consensus, with good reason, with all the deflationary forces we're still facing, even with the fiscal and monetary stimulus, it's unlikely we see inflation becoming a problem or an issue of significant concern for probably at least the next 3 years and potentially 5 years or beyond.
yep. All right, next slide. So up till now, the first 4 areas, we would say, yeah, pretty good inflation hedging, but different characteristics on each one and different power level of inflation hedging. This number 5 used to be the playbook for inflation hedging commodities. And up until the Great Recession, it was pretty reliable that commodities of all kinds, metals and energy, oil, commodities like crops and things, that some of those would follow inflation going up. And so if you invested in commodities, you had a pretty good hedge. Well, for the last 11 years, commodities have been very poor inflation hedges. And again, this was one that we had our last commodity fund that we sold out of in 2008. And I would have probably guessed that we would have been back into it within 5 years. Haven't touched it. Now, we have selectively done bargain hunting in a few areas, including gold, as you know. And so, again, commodities as a general area, at least for right now, we would not probably be in favor of. And the questions down below, there is tremendous demand supply imbalances in different areas. There was China that was basically cornering the market on some commodities, and like copper at one point. And so is that really a reflection of anything other than just things going on within a particular country? No. And so there's also a lot of work going on in the nano area and the nanotechnology area that I'm involved with our Nano Center, to create some of these things in the future that are better, stronger, lighter weight, cheaper. And so the whole commodity area, I think, is much more nuanced today than perhaps in the past. Let's go to the next slide.
Thank you. So the final category we're going to talk about in terms of inflation hedging investments is the very simple of money market, short-term bonds, the near cash category that Glenn was describing earlier on as part of money supply. And historically, you've seen that your yields on perhaps CDs, money market funds, et cetera, were marginally ahead of inflation. The last 10 or 11 years, as we've seen a more pronounced downward trend in interest rates, and particularly most recently where essentially money market funds have no yield, they haven't really been an inflation hedge. Probably as inflation creeps back up, it's going to be hard for these areas to keep up with inflation until we see the Federal Reserve and overall yield environment get back to similar rates. So until the Fed funds rate is coming closer to inflation, it's hard for a lot of these funds to produce any real yield. Long-term future, I think it's still reasonable, and perhaps, Tara, if we're thinking about financial planning horizons, 20, 30 plus years, I think it's still reasonable to think that on average, these will at least tread water, at least keep you even with inflation. But again, that may take a couple of years before we get back to that environment.
Yeah, we still hope that our clients who are 10 or 15 years away from retirement, that maybe by 10 or 15 years from now, we'll get back to a time when these kinds of investments and bonds in general are making good returns over inflation. But that certainly is not now, or probably not near term. All right, let's go to the last slide. So future trends to consider. Again, I think our general opinion is that when you've had radical intervention like we've had during the pandemic, there will be unintended consequences. We're just not sure what all those consequences are yet, and they are counterweighted by some of these super trends that are as powerful as anything going through the economy right now. So this gets back to our special report that we did on factfulness, and you should never rely on one data point to say, oh, everything's going to be terrible, like budget deficits have increased. You should look at multiple data points to see how things are impacting each other. So future of healthcare, we've had several of our live chats around telemedicine and other healthcare innovations. And a lot of those new technologies are deflationary, not inflationary. And we knew this was coming. We had, in fact, we had done special reports and programs on the fact that Medicare costs in some areas were probably going to go down over a 10-year period of time. Well, the pandemic has actually accelerated some of that. So stay tuned, because we, again, I think we may find that there will be a lot of deflationary forces, probably not ready yet in our financial plans to take healthcare inflation down from 5% a year. As Tara mentioned, we're still a little from Missouri that overall healthcare inflation will go down over time. But again, some of the evidence is suggesting maybe it will. The second future trend, consumer buying power, we've already talked about. JT talked about the Walmart effect that ultimately led into the Amazon effect. And so that has allowed a lot of options for consumers to shop prices. There was that congressional testimony some years ago where one of the senators mentioned that Walmart has done more. I think it was the senator from the state that Walmart was based in. So take this for what it's worth, but that Walmart has done for the poor, more for the poor and working poor than the US government itself has done in terms of keeping prices low. And Amazon has just taken that to a whole new level, although Walmart's still a pretty important link there. And so this future technology in the hands of consumers is just going to continue to magnify that effect and create deflation in some goods and services that are more commodity-like. Let's see, toilet paper maybe comes to mind, which was in high demand at the beginning of the pandemic. But you know, we also know we have clients who like a particular kind of toilet paper. We won't get into 2-ply, 3-ply, padded, whatever. But the fact is that certain brands still hold sway with folks, and they'll be willing to pay more for that. So maybe there's not as much deflation in certain areas. The China Cold War, this is something that we have talked about in some of the chats. It is definitely something to keep an eye on for the future. And so, you know, whether that war is simply an increased business competition, which has been our kind of main scenario. However, we know that we're in a cyber warfare situation with China as well, or whether it gets more confrontational. Any of those things that interrupt the Chinese supply chain can have effects on inflation. And again, I think the thing that we all need to keep in mind is that, as we mentioned in our last chat, Poolside Chat, there are shifts in supply chains going on right now. Many healthcare systems are saying we don't want things tied to China, but there are other areas that are increasing their ties to China. Apple, Tim Cook has leaned in that they're going to increase their supply chain manufacturing in China, and hundreds of other CEOs of Fortune 500 companies have said the same thing. So China remains an interesting wild card on a whole bunch of fronts in the future. And then finally, deglobalization. JT already touched on this. And I think the great metaphor here is, what if we had the de-United States of America? What if we had 50 US states that all could set their own tariffs on everything? Trucks coming across borders, people basing headquarters there. We already have 50 states who can set sales taxes and state income taxes and a variety of other things. But what if it were like 50 countries all doing different things? Well, those studies, some people have a lot of time on their hands to do analysis in the academic world and Federal Reserve, and they've actually determined that it would be tremendously negative on the growth of the United States. And it would be maybe a clear and present danger to our ability to stay a leader in a lot of different areas. So again, deglobalization is a potential threat that, as JT alluded to, can cause future inflation. So another thing to keep an eye on. So I think what you get back to here, this is our classic that we've talked about 10 years ago and 20 years ago, was King Kong versus Godzilla, inflation versus deflation. And the technology accelerators and automation side are much bigger today than they were 20 years ago. And they're much more powerful forces. I mean, we all forget that this little thing called a smartphone is a relatively recent invention, and all the things that come with it. So there's going to be powerful forces on the inflationary front, deflationary front. We actually think that our portfolios already have a fair measure of defense if inflation surprises us on the upside, but we're going to keep watching it. And as JT and Glenn both said, adjusting as we go. So with that, I'd like to wind it up, and again, thank Tara for some of her great research for this inflation piece. Who knew that the Federal Reserve would actually make it a bigger topic than we even thought it was? And then thank you, Glenn, thank you, JT, for leaning in on the economic and investment front. In the meantime, if you have any further questions on this, please feel free to reach out to us. And I'll remind you that these are recorded and will be available on our SFG YouTube channel for viewing at a later time. Thanks, and have a safe and wonderful weekend, everyone.